If you look at a 50-year perspective of this whole value growth dynamic, people are underappreciating how extreme the current starting point is, that we've never been in such a period where high PE stocks have outperformed so much and low PE stocks have lagged. And it's basically been one-way traffic for almost 14 years now. The extent of the outperformance is about 3 times the size of the dot-com boom, to give you a sense of just how incredibly stretched it is. So I think the first thing is just the starting point. People are not realising what good odds you're getting by playing the value and cyclical space. The second one is, everyone, the most common question I get is, why now? Why is it suddenly going to change? And I think there's 3 reasons. The first one is the vaccine recovery. So as the rollout takes place around the world, the companies that are most likely to benefit are those ones that have been hit the hardest during COVID, and also the ones that are most economically sensitive, because obviously as the vaccine rollout happens, those companies start to get the benefit of the economy recovering and emerging from the crisis. The second factor is that we think there's going to be an enormous mergers and acquisition wave that's going to come through over the next 12 months. Every person we speak to that's working in an investment bank or a law firm or a private equity firm is saying how busy they are. They've never been so busy in their career. It's very reminiscent of 2007, for anyone who remembers the private equity wave of acquisitions that happened then. And typically the companies that get targeted are those ones that are undervalued, and they tend to have some economic sensitivity if you're coming out of a crisis. And obviously value and cyclical stocks are more likely to get the bid rather than a growth stock on 50 or 100 times earnings, where it's much harder to make the numbers stack up for either a corporate or private equity. And then the last one is, as you said, inflation ticking up. Clearly, if inflation is going to move higher, and we think it is, that would trigger a rotation from long duration stocks like those growth stocks and bond proxies into those short duration assets, which are typically things like energy or financials and a lot of those typical sort of classic value stocks. We're not saying this is going to be a 10-year trend, but definitely over the next year or two, we think that the lead indicators that you can see in the PPI, the ISM, all the company contacts that we have that keep telling us that they've got so much price pressure coming through their business and they're looking to raise prices. We think that as you go through 2021, particularly towards the end of the year, you'll start to see inflation tick up. And then what I think of as the big money, the mutual funds, the endowment funds, pension funds, sovereign wealth funds, they're all going to start to think about maybe we do need to rotate. I think so far we've only seen this initial repositioning, this sort of positioning squeeze from hedge funds and from retail investors when you started to have the vaccine trade happen. But now I think it's going to broaden as we get through the next 12 months. Central banks are finally our friend. We've been frustrated that effectively central banks have been causing a one-way trade in long duration assets, whether it's the growth stocks or the bond proxies. And the reason it's a positive today, even though at face value it's the same decision they're making, which is to have easy policy, is that they're essentially anchoring the short end of the curve at 0. But as global growth accelerates, and we think global growth is going to be more than 6% in the second half of this year, and US GDP growth is going to be more than 6%, you're essentially putting your foot down on the accelerator at the same time as the global economy is already roaring, and you've got this massive pent-up demand from the vaccine that's going to unleash everyone going and travelling and going to restaurants and going out for entertainment. So essentially you've got the most perfect environment for a cyclical. You've got a depressed share price, you've got central banks being as easy and stimulatory as possible, you've got governments being stimulatory, and you've also got global GDP roaring as a starting point. So we think why would you want to be in defensives when cyclicals are the cheap part and they're also the most economically sensitive? In our portfolio, we're allowed to have up to 30% of our portfolio at a gross level overseas. That could be long or short. Today, more than half of our exposure in terms of our long exposure is overseas. And that's very different from where it was, say, 6 months ago when there was a more pronounced skew to Australia, because Australia looked much more undervalued at that time. We think that one of the great ways to play it is through Airbus. Airbus, a company everyone would know. It's a duopoly with Boeing. They're by far the leading player in terms of their planes and also their exposure to narrow-body planes. So narrow-body planes are those aeroplanes with a single aisle. That's where the whole market's going. Everyone wants to do point-to-point. People are sick of the stopovers in various hubs around the world, and narrow-body planes are better suited to that. So what Airbus has come out with is better fuel efficiency, longer flight range, and a lot of the creature comforts that have sort of separated them from Boeing. Boeing's also had some operational issues, which everyone will be aware of with the MAX, and the order backlog for Airbus is actually 10 years. So you've got a lot of certainty about the production profile going forward, and the shares are still trading at a big discount to where they were pre-COVID, even though we think the outlook is incredibly positive.